Hey everyone, Coach Investor back to another earnings video for today. So as promised, here are my thoughts on the trade desk, what happened after they reported earnings, whether or not I have bought, whether or not it is a good time to buy this stock. We're going to discuss all of that in this video. So first of all, I want to touch on the aspect of valuation. Because currently the trade desk is valued at around $31 billion, has a forward PE of 47.9 times. It's up 41.3% year to date. Now, of course, after they reported earnings, the stock after hours was down close to 30%, but then during the day it was only down around 18% or so. So quite a nice rebound from the after hours action. Now, currently, if you look at year to date PE, it's up. Forward PE is up 12.31%, yet the stock is up 41% year to date. With regards to EV to EBITDA, it's up 17.31%, and again, stock is up 41% this year. And overall, if we look at the last 5 years, let's look at the last 5 years, what's happened there. When the last 5 years, the mean for its forward PE was 89.1 times, EV to EBITDA 59.9 times, price to sales 20.2 times, and then price to free cash flow, that's in the last 12 months, that was 134.7 times. And now, currently, well, the next 12 months for PE, EV to EBITDA, price to sales, price to free cash flow is all well below the 5-year mean. Now, of course, you might say, yeah, okay, fine, it's below the 5-year mean. But I mean, look at those numbers. It's quite expensive. And I agree, it is quite expensive. But as we've seen with many other quality companies that get a premium no matter what, I mean, this is a great example of a company that has gotten a premium for a long time, yet the stock is down heavily after they reported earnings, and it's still trading at a premium, but it is cheaper. Now, we've seen this with Adyen as well. After they reported their weakish outlook, stock crashed 50% and it stayed down at 50% for quite a while. Then not so long ago, they had their new business meeting, investor meeting, talking a bit more about the industry and their own outlook. The stock rebounded pretty heavily. But even when it was down 50%, the stock was still expensive. If you look at the traditional valuation metrics, it was still at expensive levels, but much cheaper than its 5-year mean. Again, quality companies, qualities with great management, great execution, usually trade at a premium. Same can be said here with the trade desk. Same can be said with a lot of other companies out there. Now, unfortunately, the stock did not stay down 30%. It was close to around $52 or so, which if it was trading right now at $52, I would have probably added to my position. But since it is now trading at very close to the price I had bought, I'm not really willing to add currently. But I'll show you the numbers, I'll show you the weaknesses as well in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. And thank you to all the new members, your names will pop up here on the screen. Thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start here with a couple of comments from Jeff Green, co-founder and CEO. So Q3 was a strong quarter for the trade desk as we delivered revenue of $493 million, accelerating growth to 25%. This performance underlines the premium that advertisers are placing on precision, agility, and transparency as they seek to maximize returns from their campaigns. As we enter our busiest time of the year and look ahead to 2024, we have never been in a better position to capture a greater share of the $1 trillion advertising total addressable market. With the generational shift to CTV, which is streaming and all of that, the growing opportunity in shopper marketing, our leadership in identity, and our most important product release ever with Kokai, we are better positioned than ever to help advertisers leverage data to drive growth and differentiate their brands. Of course, you might say, okay, this is very positive, so why did the stock drop? Well, the stock did drop because of guidance. Now looking here at the GAAP results, you can see that revenue increased 25% year over year when the year before that increased 31%. So still very nice and strong growth there. Net income is positive, not by much, but still positive. Adjusted EBITDA here on a non-GAAP basis 200 million compared to 163. The margin is 40%, which is down 1% year over year. Non-GAAP net income $167 million and non-GAAP diluted earnings per share 33 cents. Now, as always, strong customer retention. The retention remained over 95% during the third quarter, as it has for the past 9 consecutive quarters. Now, here they talk a bit about all their achievements, their releases, etc., etc. I'm not going to bore you with all of that. We'll jump into the most important parts. They bought $90 million worth of their own shares. As of September 30, 2023, they had $273 million available and authorized for repurchases. Now here it comes, fourth quarter guidance, so revenue at least $580 million, adjusted EBITDA of approximately $270 million. Now, it's important to mention here again that usually their outlook, there is this word here, 2 words, at least. So it's going to be at least $580 million, which was below the market's expectations. Now, why did they miss guidance? Because I do believe that this is the first time since they are a publicly traded company that they missed that expectation. So they said here during the earnings call, we represent the vast majority of the Ad Age top 200 advertisers, the largest advertisers in the world. Starting in the second week of October, we have seen some transitory cautiousness across some of those advertisers. These include, for example, industries that have been impacted by recent strikes, such as the US auto industry. Through the first week of November, we have seen spend stabilize and we are optimistic for the remainder of the year and 2024. So this to me means this is just a one-time thing because of something that was out of their control, which was the strikes, but they are very, very optimistic for 2024. Now, they continued by saying here, we are cautiously optimistic for Q4. Again, this is why these words, at least, are important to add to the overall context. They continue by saying here, regardless of what the macro brings, we believe we have never been in a better position than we are in today, with large growth drivers, including the ongoing secular shift to CTV, upgrading measurements with retail data, our biggest product release ever with Kokai, growth in international markets, and identity framework that has never been stronger, the US presidential election cycle, among others. We remain optimistic for the remainder of Q4 and into 2024. Now, of course, buying a stock like The Trade Desk is not a stock that you're wanting to buy just for a quarter or two, nor you're in it for the long-term success of that company in a very big industry. I mean, that $1 trillion total addressable market, the serviceable addressable market is obviously a bit smaller, but you're still talking here about hundreds of billions of dollars. So, I mean, the future is bright, especially if you see how small of the pie currently The Trade Desk is eating, let's say. Now, they did say something else here in the earnings call. We believe the ads we show in CTV in 2023 are more relevant in CTV than they've ever been before in TV or premium video. As the value of these innovations has proven out in the CTV advertising market day after day, we continue to see more premium inventory flow into our platform. Disney, for example, just opened Disney Plus inventory for us across Europe. Of course, Disney has been a partner for The Trade Desk for quite a while. They also say that retail media is becoming bigger and bigger for them. We know that they have been working with Walmart, with their DSP for a while as well. So, I mean, the more and more people move, of course, from linear to connected TV to streaming, the more advertising dollars will move as well, and the more companies like The Trade Desk will take for their own business. And believe it or not, we're still in the early days. And so if we look at the graph, this is on the weekly chart. Of course, we had that huge red candle when they reported earnings. Could have been a much bigger one. Like I said, after hours, we were trading at around $52 or so. So for those of you that can trade after hours, I mean, you probably got a pretty good deal there. But this week, currently, we are still in the red. RSI is not even close to being oversold. Of course, picture could be different if it was trading at around $52, but right now, I mean, pretty close to being neutral. The 200-day moving average sits at around $71. So to conclude, despite a small miss in guidance expectations, The Trade Desk, the business management is still executing their plan pretty well, I should say. Now, remains to be seen what happens in Q4, but in my opinion, they're probably going to beat their at least revenue target. Going forward, yes, the stock is going to be expensive. Maybe it will be cheaper depending on how fast the business can grow and how fast the stock goes up or down. Unfortunately, I did not add when it was at $52 after hours. Right now, I'm sitting on the sidelines. If we're seeing more weakness in the stock and the stock does go into the 50s, the low 50s, then yes, I will be more inclined to add to my position. So that will be it for this video. Of course, do share your thoughts down in the comments below. If you enjoyed this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.